And then we have temporary versus permanent current assets. So permanent current assets are the level of current assets or that inventory that we retain regardless of any seasonality in sales. And then the temporary current assets are the current assets that we add when we expect an increase in sales on a seasonal basis. So we might have just regular stock that we carry 365 days a year, and then we have extra stock or temporary stock that we carry only for seasonal events. These graphs here on the next slide show examples of the seasonability of stock. So we have different seasonability, which means that then we have different cash cycle requirements. And we can see the dips where we have cash surplus and when we need to fill in with marketable securities because we have a shortage. In policy F, we have cash surplus or a large investment in marketable securities that can be easily sold off to pay cash for things. With policy R, we use financing for permanent assets requirements. So we take out loans anytime we do a permanent asset, and short-term borrowing for seasonal variations. That short-term borrowing can come through short-term loans. It can come through a line of credit at a bank. So when we're trying to choose the best policy, we need to think how much we want in cash reserves. What do we want to have available in cash reserves? The maturity hedging is the decision between like using short-term debt to finance long-term assets or using long-term debt to finance short-term assets. So we want to hedge against those opposite maturity. We don't want to find ourselves in a position where we're using long-term debt to finance short-term or current assets. And then what are the relative interest rates? Do we get better interest rates on long-term financing or short-term financing? Do we have better interest rates if we put our cash in money market? Or do we have better interest rates if we have a line of credit available for any cash shortages? So the compromise policy is where we look at a little bit of both, where we maintain a cash reserve for emergencies and normal operations, but we have that short-term borrowing available to meet those peak needs or seasonal needs. So this shows the compromise policy in the middle of the flexible policy and the restrictive policy, where we have both short-term financing and cash and marketable securities available. Another tool that we use in short-run financial planning is a cash budget. So you should recognize a cash budget from your accounting classes, where we look to identify when we're going to have those needs for cash, when we might need short-term financing, what our cash needs are. We look to identify when we're going to receive cash and when cash needs to be paid. So we're going to look at an example of a cash budget here for a toy company. So we have information about our expected sales for the next 4 quarters. We have our beginning accounts receivable, and then we have our collections, our beginning receivables plus half of sales. Our accounts payable is 60% of sales. Other cash outflows for other expenses are 20% of sales. We pay interest and dividends of $20 million per quarter, and we have a major expansion plan for Q2 costing $100 million. We have a minimum cash balance requirement of $10 million, and our current beginning cash is $20 million. So we take all of that information and we build our cash budget. We add our cash collections, So what are our beginning receivables? How much are we going to receive in cash sales? How much are we going to receive in cash collections? And what are our ending receivables going to be? Then we have our payments out. So we have payments out to $128 and wages, it's in millions. And we don't have any capital expenditures in quarter one, but we do have a capital expenditure in quarter two. We also have the interest and dividends that we pay every quarter. So when we look at how much cash we have, so in quarter one, we collect $220 million in cash and we have disbursements of $180 million. So we have $40 million in cash available. Okay. We have a minimum cash balance of $10 million. So we have cash surplus at the end of quarter one. But at quarter two, quarter three, and quarter four, we have cash deficits. So we have to have this coverage of our cash deficit. We can either use a line of credit, which is a prearranged agreement with the bank that allows us to borrow on a short-term basis. It might require a cleanup period, and a cleanup period is where it says we can't take anything for 60 days at the end of the year just to make sure everything gets paid up before the end of the year. Or we can have a formal legal agreement that requires a commitment fee and has a floating interest rate. With a committed formal legal arrangement, we might have a minimum cash amount that we have to keep in an account in order to take that line of credit. So the non-committed or also an informal agreement, this is similar to a credit card debt for individuals that I just have some amount that I can take. I can have revolving credit, which is a non-committed agreement with longer time between evaluations, meaning I don't have to maybe repay it every month or repay it every quarter. I have a little bit of more flexibility with my cash. Other types of short-term borrowing are using accounts receivable as financing. One is to assign receivables, where we use our accounts receivable as a secured loan. So we're responsible for the collection as a company, but the lender has the payments of our accounts receivable as security that we're going to pay our loan back. The other method is in factoring receivables. This is where we sell our accounts receivables to a factor, and they are responsible for collecting it. When we factor receivables, we will sell it for a discounted price, and then we put the onus on collection to them. There are other kinds of things that aren't covered in the textbook as much, but there are other policies, such as if anyone has a Target credit card. Target credit cards are backed by Visa. So Target has 0 accounts receivables on their books. They just accept they get cash from Visa at the time of sale, and Visa is responsible for collecting the accounts receivables. So they just pay Target cash minus a fee. It's similar to factoring receivables, but it happens before the receivable instead of after the receivables where they're sold off. We can do secured loans. So we can have a lien against all of our inventories, where if we didn't pay our loans back, then they would confiscate our inventory and sell it in an effort to regain the cash. We could have a trust receipt where the borrower holds specific inventory in trust for the lender. Example of this would be like an auto dealer that might have floor inventory or inventory that's being held in trust. We have field warehouse financing, which is a public warehouse that acts as a control agent to supervise inventory for the lender, to make sure that you can't, if we have a lien against our inventories, that we can't like get rid of it under the lender's nose. So looking at this short-term financing. So we're going to have to take out short-term financing at 20% APR calculated quarterly. So we begin short-term financing in Q3, and then we have to pay it back. We still have, where it shows the change in short-term financing, what we pay back, and our interest. When we go, this is the end of chapter 16, but we will continue this into chapter 16, where we talk more about those lines of credit, the timing between accounts receivable and cash purchases, and the types of fees that are required for lines of credit.